Hey everyone, welcome to Retire with Style. I'm Alex and I'm here with my good friend and trusted companion, Wade Fow.
Hello, everyone.
Hello, Wade. And today we've got an action packed episode on tax planning, so buckle up. But before then, just want everyone to know that on March 10th through the 13th, from 12 to 2 o'clock, we are having our
Eastern time.
retirement. Eastern time, thank you. We are having our retirement income challenge. Think of it like a juice challenge, only for retirement income. No, it's really to get everyone getting going. For all of you that had those New Year's resolutions and you're still thinking about opening them up and executing, well, we've got a great challenge for you to get that ball rolling. Wade, what are we going to cover in the retirement income challenge?
Well, if you have not had a chance to take the RISA before, you'll have a chance to do that. If you've taken the RISA, that's fine as well. We'll talk about the RISA, and then we'll give everyone access to our funded ratio tool throughout the week. And we'll talk about how to use it. We use the funded ratio to calculate whether or not you are on track for retirement, whether you have sufficient assets, and that can include future earnings and so forth, but whether you're on track to enjoy the retirement in terms of being able to meet the expenses you have in mind to have a great retirement. And if anyone would like to join us for that, it's 4 days, 2 hours a day for 4 days. Lots of homework too with between the RISA and the funded ratio. It's at retirementresearcher.com/RIC.
And I highly encourage everyone to sign up quickly. We don't close it because it's a Zoom thing, but we have, it's usually well over 400 folks that take us up on this. And at the end of the week, it's very gratifying because we create 350, plus or minus financial plans. And so that's something that actually kind of gotten a kick out of that, Wade, over the years to be able to have that kind of impact. So please join us on this. We run these about 4 times a year, and I enjoy it tremendously. Do you, Wade?
Mm-hmm. Yeah, absolutely. It's a really good chance to interact with folks and hear what's on everyone's minds. And this is intended more, we have a split audience. This is more for not financial advisors who are listening, but more for the end retirees themselves who are trying to plan for their own retirements.
Yeah, although interesting, right? How we become the advisors over time, where we picked up, plenty of folks interested in our services simply from advisors that joined us, and they're like, "Hey, by the way, I need help for my own stuff." But that's a side note.
Right. Oh, sure. Yeah, and if advisors want to plan their own retirements, they're welcome to join us for that.
It happens more often than you think. But thanks. The other piece is your retirement planning guidebook is out. Just a reminder for everyone. You want to give everyone a quick snippet on that?
Sure. The 2025 update of the Retirement Planning Guidebook is now available through your favorite book retailers. If you want an actual physical copy, Amazon's the place. For ebooks, you've got a whole host of options. They're all listed at books2read.com/retirement. And that's the number 2. So books, the number 2, read.com/retirement.
And Wade, I love your little Vanna White impersonation there. When you Wade has, for those of you listening, Wade has like his books on the back. It's a total flex move. He has a bookshelf, and he has his books over his right hand shoulder, and he gestured with his hands a la Vanna White. It's hilarious. All right, and so let's get cooking for today's episode. What's on track for today?
Yeah, give me a T for tax planning, Alex.
T. Yeah, there you go. I'd like to solve that. Wait.
All right. But yeah, the idea today is, so we've talked a lot in the past about tax planning, tax maps, looking at, is there an opportunity to do a Roth conversion or maybe to realize some long-term capital gains, especially at a 0% tax rate? We've talked about how there's great software that's out there. Joel Sasser, his Covisum, has created the software for financial advisors, but it's priced for financial advisors. So the do-it-yourself community doesn't really have a lot of options in terms of good software to look at that. I do all my programming in MATLAB. It's not interactive for other people to be able to use that. But really, I've been working on this idea of, is there something I could create in Excel so that we have an interactive spreadsheet? And that's not going to solve the lifetime problem, but for 1 year, you kind of have a chance of, what would be the overall impact of doing different tax planning type decisions if I voluntarily get some income, or if I'm thinking about should I contribute to a tax deferred account or the Roth account? What are the overall tax impacts of these types of decisions? And since that all worked out well, I'm going to do a workshop on that for our Retirement Researcher Academy, which is our paid membership site that we have as well. We haven't talked about that a lot on the show, but we do monthly workshops. And this month I'll be talking about this tax map calculator. And people have a chance to hear how that works and use it for themselves. And I think it can be really helpful on a year-by-year basis of making big picture decisions about Roth conversions, long-term capital gains, harvesting, and so forth.
Yeah, and so in the show notes, we'll have a link for the Retirement Income Challenge. I highly suggest you take us up on that.
And that is distinct from what I'm
talking about. Yeah, that's distinct from what we're talking about. There's the Retirement Planning Guidebook, which is, ever present on Amazon and wherever books are sold, as you like to say, Wade. And the workshop on tax planning with Wade's calculator, we're really breaking it down for his tax mapping spreadsheet. We're going to have a workshop on that. And part of the reason is, too, there's only so much we can do on this podcast using your ears. It's a little too tough to break down spreadsheets and the like. So that's February the 19th. And Wade is not wrong when he says that. It's a highly desirable session because I think directionally you can be pointed in a lot of good directions. That being the case, Wade, want to kick off this episode and probably preview a lot of what's going to be in the workshop, but I think we can, handle some nice details.
Absolutely. Yeah. And so we have run a tax planning arc recently. So if you go back within the last 20 episodes of the podcast, there's detailed episodes about a few different things that I'm just going to remind everyone about rather than going into detail about it. But what this tax map calculator will account for as you generate ordinary income or the preferential income, the term I use for the long-term capital gains or qualified dividends, the overall tax impact that has, not just with federal income tax rates, but with how that would impact if you have claimed Social Security, the impact on the percentage of your Social Security benefits that are taxed. That's the Social Security tax torpedo. We also include the IRMAA surcharges. That's with Medicare. If you're at least 2 years away from beginning Medicare, how that could impact the premiums that you pay 2 years later. That's the Medicare potential surcharges on your Part B and Part D premiums. The net investment income surtax, so that 3.8% surtax, accounting for the idea that long-term gains and qualified dividends, your preferential income, stacks on top of your ordinary income. And so if you're doing a Roth conversion, that could also uniquely push long-term gains into a higher bracket as well, separate from your ordinary income. So including those impacts. And then the thing that's also new as I was doing the calculator, I realized this is something I hadn't really talked about before, but it's pretty easy to also include. And that is, if you're itemizing and have deductible medical expenses, there's a rule that the deductible medical expense, the qualified medical expenses, in excess of 7.5% of your adjusted gross income are what you're able to deduct. And so you have this issue. As your adjusted gross income increases, the amount of your medical expenses that you can deduct declines. And as I was creating the Excel version of this, I did include deductible medical expenses as part of the analysis. And so that can, the loss of those subsidies, it's not as hard as it might sound. It's, if I generate another dollar of ordinary income and I'm itemizing, so if you're just taking the standard deduction, this doesn't matter. But if you have significant medical expenses that are qualified, you're itemizing your tax returns. If I generate another dollar of ordinary income, that will reduce the deductible amount of my medical expenses by 7.5 cents. So it's really $1 of ordinary income is causing a tax impact of like $1.07. Yeah. Or if it's $1,000, then we'd be talking about $1,075 is the practical impact of that. And then you just multiply that by your marginal tax rate at that point. So if I'm in the 10% tax bracket and I'm losing deductible medical expenses here, then it's really a 10.75% marginal tax rate. If I'm in the 12% bracket, it's like a 12.9% marginal tax rate. 22% bracket, I think that one was 23.9%. It's just it's 22% times the 1.075 to let you know what your overall tax impact is if you're losing deductions as you generate more income. So those are the factors, and then we're just going to use those to understand the tax impacts of different decisions.
Okay. And are there any questions that, practical questions that someone can answer from this? Like, should I do a Roth conversion or gains harvest at 0% rate?
Yeah, I think that's an important one to start. And this is also something in the past I've talked more about prioritizing Roth conversions. And I would get pushback from listeners saying, maybe you should put more emphasis on generating long-term capital gains at 0%. And working on this calculator, it's a lot easier for me to look at different cases quickly with this calculator than it is with my MATLAB programming code. So it does make it easier to start digging into this more. And yeah, I can kind of see the point of, like, let's just talk about a simple scenario here. Yeah. So it's pre-claiming Social Security. Say you're 62 years old. So you're not claiming Social Security yet because you're going to delay. You're not yet worried about the Medicare IRMAA surcharges. You're retired, so maybe you've got, $10,000, $20,000 of income from other sources. But you've got a long runway here where you can make some decisions. If you're taking the standard deduction, you can get up to now, it's with ordinary income, $126,700 ordinary income. That's the right number, I think. No, sorry. That one would be $126,950 before you enter into the.
Corrected that way because I was thrown.
Well, somebody.
I was thrown into a tizzy. No.
Somebody listening would have definitely caught that, I'm sure. We've got some eagle-eared listeners.
Yes, I'm well aware of that.
Yes, you
more
are.
Like an owl. No, a bat.
But yeah, it's with ordinary income, you go through your standard deduction and then the 10% bracket and then the 12% bracket. And if you're just taking the standard deduction, that gives you that opportunity for $126,000. And you're under age 65, so you don't get those extra additional standard deductions. But $126,950. If you're generating long-term capital gains, or you had, including your qualified dividends, you can get all the way up to $129,900 before you'd pay any taxes at that point. If all your ordinary income falls within the standard deduction, the whole runway up to $129,900 could be filled with long-term gains. And again, your pre-Social Security, pre-IRMAA surcharge concerns, this is still outside of where the net investment income surtax would be an issue and so forth. We're assuming you don't have qualified medical expenses. You have a 0% tax rate potentially, unless there's other things in the tax code that haven't been factored in, or if you are using the Affordable Care Act for health insurance, that would be something to consider. But you could potentially pay no tax on a lot of long-term capital gains there.
So to me, the point is, this is an interesting scenario that you said, but this points to the potential use cases that you could do within that calculator regarding gains harvesting, if you will.
Right. And so you're kind of your choice here. And the example that I created to demonstrate this for the workshop, they did have $12,000 of other income, the interest income, different things, whatever it is. But then they had a runway. They could have more than $114,000 of additional income. And in the past, I would have said, probably in most cases, want to emphasize Roth conversions for that. If you were targeting any tax rate at higher, 12% or higher, you'd go up to the end of the 12% bracket with that. You'd be paying more than $11,000 of taxes on a Roth conversion to get you up to the beginning of the 22% bracket. If you instead just took an opportunity to harvest gains, so I've got these long-term gains, I'm going to realize them, capture them, sell the asset, and immediately repurchase it, which you don't have any wash sale rules or anything when you're harvesting gains instead of losses. I increase the cost basis of my investments. That will potentially be helpful in the future to reduce the
Yep.
tax impact in the future. And I could get up to that same general level there. There's a $250 difference between them, but that same area of a lot of income there with no tax on it, increasing the cost basis. And I'm more open to the idea of doing that. The only kind of the way that could backfire if you end up not living very long, you do get that step up in basis at death and so forth that you would otherwise not really have needed to do this because you got the step up. But
At that
unless
point, though,
you're
it doesn't become a you problem. It becomes the other person's problem, I guess.
right. But unless you're really overfunded so that you're kind of in a situation where you're never going to have to sell shares to meet expenses, which is probably fairly atypical out
Yeah,
there.
I agree.
You might want to go ahead and realize these gains at 0%, increase your cost basis. And that can be another way to get you better set up for future tax planning opportunities, especially to be more prepared to not have Social Security be taxed as heavily, to make sure RMDs don't have as big of impact for you, to help avoid those Medicare surcharges and so forth at a later point in retirement.
No,
So it's, do I do the Roth conversion and pay $11,000 in taxes, or do I do the long-term gains and pay 0% or $0 in taxes? I'm more open to the idea. In the past, I would have said, "Oh, you probably just do the Roth conversions," but I've been convinced by various folks who are saying, "Well, maybe you just want to take the long-term gains and harvest that at a 0% rate."
yeah, because then when you take the point being that again, atypical people are not necessarily going to die with those holdings. They're gonna take distributions from them, and if your basis goes to, if you don't have any basis anymore on it, then obviously the capital gains tax in the future when you take sustainable withdrawal rates are de minimis at that point.
Yeah. The higher your basis, the less you have to worry about the tax impact of selling shares to meet spending goals.
That's what makes this very attractive from your standpoint. But again, it's a break even, like anything, right? It's a break even. When does it make sense, etc. And so you've positioned it you've positioned the calculator, if you will. And I'm not doing it justice by calling it a calculator, but it's an Excel spreadsheet, so it's hard to say more than that. But it's that's one use case. Are there any other use cases that you found useful for this? I have here on my list offsetting a medical deduction.
Yeah, and that's for the calculator. I initially was thinking mostly in terms of Roth conversions, but I set it up for you to be able to look at both Roth conversions and gains harvesting, and then you've got the flexibility to decide which way to go with that. But yeah, the next one would be offsetting a medical deduction. I did kind of give the punchline to that already, which is
at the beginning. I know I was debating, but I
but
think
yeah,
you came in hot, so people may not have been like mentally prepared for the foul facts, So maybe you
like in the case study in the retirement planning guidebook, I assume they take the standard deduction, so this issue doesn't apply. But if you have large medical expenses, so that you're able to actually itemize on your tax returns, you have that rule. Only the qualified medical expenses in excess of 7.5% of your AGI are deductible. So if I'm deducting medical expenses and then I decide to do a Roth conversion, say just $1,000 Roth conversion, not only do I increase my income by $1,000, but I reduce my deduction by $75. So in practical terms, I'm going to be paying taxes on another $1,075. And so then it's just a matter of you're going to face a slightly higher marginal tax rate. Again, if I'm in the 10% bracket, by also losing out on the deduction, the effective marginal tax rate is 10.75%. If I'm in the 12% bracket, it's 12.9%. If I'm in the 22% bracket, it's 23.9%, I think. I have that number written down somewhere, but it's just it's 1.075 times the marginal tax rate would give you the actual effective marginal tax rate.
And there you have it. All right, so that was the medical stuff. Going back to since we mentioned, should I convert Roth or the like, this was convert Roth or harvest gains. The other piece is, let's say you're contributing and I get this. This is one of these Mount Rushmore of questions that we get all the time. 401k or Roth 401k? Would the calculator take into consideration that?
Yeah. So it's not designed. I mean, the original idea was to think more about Roth conversions, but you can.
Can I before you get going? So, there are many calculators that you can get, like Dinkytown and stuff like that, consumer related calculators that may do something quick and dirty. But as you answer this, I think it'd be interesting for those folks to realize that this isn't just like a one of those lead magnet calculators that you see on, like, those banking sites or whatnot to get you to do some other thing. And so, if you don't mind, like, what above and beyond did the contribute to 401k versus Roth 401k is included in this to really give it the sophistication it needs that you don't really see in most common denominator consumer calculators, if you will.
Well, it's just going to look at the impact with all these other considerations. Although if you're still in your career, maybe some of these other, like the Social Security benefits and so forth, aren't relevant at that point. Yeah. But it's a quick and easy way to see what the overall impact would be, including the preferential income stacking. That could potentially be a factor that you might not have been thinking about. And so
people aren't going to realize, I know you've mentioned this in previous episodes, and we do talk about this in previous episodes when we do our tax planning arc, but just because it's a lot of syllables to digest. Preferential income stacking.
Yeah, that's the long-term capital gains and qualified dividends that add on top of your ordinary income when you're determining. And so the issue is then, if I generate more ordinary income, maybe my gains were all in the 0% bracket still, but that could push some of them into the 15% bracket. And so I'm not only being taxed on my ordinary income, but I'm also starting to be taxed on my preferential income as well. And it can be the double whammy. If I'm in the 12% bracket of ordinary income, but I'm pushing gains from the 0 to 15% bracket as well, then I have a 27% effective marginal tax rate. And it accounts for that. I guess that's probably the main thing it also does account for that would be relevant when you're working and thinking about where to contribute. And it just, so for example, we've got 53-year-olds. So they're at the point, they're going to make their full employee contribution to their 401k, including the catch-up contribution. So we're talking about $31,000. And so I look at, well, do I do an above the line deduction? Their salary is $125,000. They've got a few other income sources from like taxable interest and so forth. But do I make the traditional tax deferred contribution and get a $31,000 tax deduction for the year above the line? If I did that, I'd end up with income taxes at $8,100, $8,163 for the year. If I instead, and the way you can gimmick the calculator to look at this is make the above the line contribution, but then just do a Roth conversion on that same amount. And that brings it back into your adjusted gross income. And that's the way you can think of it, as being in the Roth account. If I just did that, so if I contributed to a Roth, I pay taxes on it today, have it in the Roth, don't have to worry about paying taxes again, the overall tax bill would have been $15,488. And in this case study, that did include not just the ordinary income, the tax on the $31,000, but also how that would push some of their qualified dividends into the 15% bracket as well. So there's an extra $3,000 of taxes on that getting pushed into the 15% bracket for long-term gains. So the overall effective marginal tax rate, if I put into a Roth instead of into a traditional IRA or traditional 401k, it worked out in this example, this case study, 23.6% was the effective marginal tax rate, even though they were still in a point where they were working through the 10 and 12% federal income tax brackets. It was that preferential income stacking issue, as well as part of their income falling into 22%, that did cause the overall tax impact to be 23.6%. So that's the number you'd want to think about. Should I get the tax deduction today, or should I put into the Roth today? It's not the fact that I might have been in the 12% federal income tax bracket. It's the fact that by putting that money into the tax deferred account today, I could save paying an extra 23.6% on those dollars in terms of the overall tax impact. And that number is higher than you might have thought it would have been. So that's how you can use the calculator for those types of decisions.
Excellent. So we got the Roth conversion, gains harvesting. We have the contribute to a Roth or 401k question. We've covered the medical deduction stuff that obviously impacts your taxes. What about the charitable deductions or qualified charitable deductions for an RMD?
Yeah. So we're now at a more advanced age. We're at an age where we are paying, we have RMDs, required minimum distributions. So say we're 77 years old and I develop a case study to show around that. Suppose our RMD is $60,000. And coincidentally, we're just a very charitable-minded household. So we're thinking to make a charitable donation in the same value as the RMD. I want to contribute $60,000 to charity. My RMD is $60,000. And so the purpose of talking about it in that manner is to just see the huge difference in the tax impact. I have two options about how to donate it. I could do a qualified charitable distribution directly to the charity and in an amount up to this year, $108,000. But we'll talk about doing it for the amount of the RMD, like a $60,000 QCD. And then that RMD does not go into my adjusted gross income. And it can be helpful for tax planning purposes. Or I could take my RMD and then I could just donate $60,000 to charity and get the below the line deduction on the $60,000 to charity. There's a big tax in this particular case study, and I could have probably designed it to show a bigger impact, but with the different income levels I put in and so forth, if that household just donated the money to charity and took the below the line deduction, their overall tax bill for the year ends up being a little over $7,000. But if they instead did the QCD as a way to make that donation to charity, keep that money out of their adjusted gross income, their tax bill for the year was $3,700. So they cut their tax bill by $3,300, or in this scenario, by almost half, by doing a QCD instead of just donating and taking a below the line deduction. So QCDs are really powerful, is kind of the theme and punchline. If you are charitably minded, taking advantage of qualified charitable distributions when you're at least age 70 and a half, and especially as a way to keep that RMD out of your adjusted gross income, can be more powerful and effective than donating directly to charities through cash contributions from other resources.
No, that's impactful. I mean, from a percentage standpoint, that reduction is beyond significant, and you're paying it forward, making a difference, right? Hey, you're doing good. You're doing good. All right. And so, again, the workshop is when again, Wade? When is it?
Well, the workshop, if you're an Academy member, so the workshop does require being part of the Academy. That's February 19th.
February 19th. And so if you want to get a real detailed breakdown of this, spreadsheets galore, and see Wade giving this a test drive, join us. I think you'll enjoy it quite a bit. And it's in the show notes along with the Retirement Income Challenge. That being the case, go on.
And yeah, and if you're thinking before joining the Academy, if you just want to get a better feel for what it might be like, the Retirement Income Challenge really is meant to provide that test drive and giving you that access to the funded ratio, working with you to build your plan on a one-to-many basis. And that's March 10th to 13th.
Yeah, and just to give you a sense of what we do. Yeah, the first day is usually RISA-driven. We talk about the philosophy, the framework, what to do. Homework that night is take the RISA. The next day, we interpret the RISA, with all possible scenarios, and which will include whatever, one of you folks will be in one of those scenarios. We'll talk about how to sort of reconcile differences when couples take it and find a middle ground. the next day, which is the Tuesday night, the homework is to fill out the funded ratio. We have an app for that on the site. And then Wednesday, we discuss the same thing. We discuss interpretations of funded ratios and how that the RISA translates into the funded ratio and how that then translates into actually putting a strategy together. But again, it's a one-to-many. We just talk about many scenarios, which invariably will cover 95% of the folks taking that. And then on the final stretch, we go into the softer side of retirement, transitioning into retirement and how that is. Believe it or not, that last section is probably the one that's favored the most by all of us. As much as Wade and I are into numbers and the like, it really is the existential sort of what now that people really gravitate towards that makes a difference. And in the final segment of this podcast, what we're doing is we're trying to be, significantly more interactive with our listeners. And as you know, we republish these on YouTube, on Retire with Style YouTube channel. So we'll put that in the show notes as well. I highly recommend everyone subscribes to that because we'll be doing a lot more things there, and especially with interacting. And we pulled out a question there that I thought made a lot of sense. Wade actually pulled it out, and we thought it makes good sense to review. And we'll go through that one. Wade, you want to kick it off?
Yeah, and it's still the case that probably 95% of our listeners are through a traditional podcast app, but we've been posting these on YouTube. And the nice feature there is you can make comments on YouTube, which you can't really do with traditional podcasting apps. And we always appreciate those comments. I know there's some that Alex really loves, but yeah, it's a good opportunity. If anyone listens to some of the other podcasts out there, but Stuff You Should Know, they always end with an email from a listener. And we thought that's a great idea, either as a question or a comment on a past episode. And this first one I picked out was more a good reminder of from a past episode. So in episode 163, Chris, and that's where we were talking about the changes that took place with retirement planning in 2025. Chris pointed out, so I was discussing the $2,000 out-of-pocket cap this year on Part D prescription drug costs for prescriptions covered through your Part D plan. In the Retirement Planning Guidebook, there is a lot more detail about this. Medicare has the Plan Finder tool. You should put in your formulary, you should put in the list of drugs you use to try to match as close as possible to what you may use the following year. And then you get to see whether or not that prescription is covered and at which tier of coverage and so forth to try to estimate your overall costs. Now, when I was talking about that in the episode, I was a little bit loose. So Chris provided a great reminder to us that regarding the $2,000 annual cap for Part D coverage, only the cost of drugs listed in your own Part D policy drug formulary count towards the cap. The choice of policy is critical. Lower premium policies tend to not cover expensive drugs. The patient has to try to predict what drugs they may be prescribed in the years ahead. And thank you. In the year ahead. And thank you, Chris. That's a great comment. I think in the episode, I was a little bit looser with my language and just talked about a $2,000 cap on Medicare covered drugs, but there is no such thing as a list of drugs covered under Medicare. Each Part D plan can have its own list. And so the $2,000 cap only applies to drugs covered on the list of your Part D plan. And so it is very important that you choose the plan that hopefully will have as close as match of making sure it covers at reasonable thresholds of payment the drugs you may need to use in the following calendar year. And that's something you're doing during each open enrollment period between October 15th and December 7th of each year. You go to that Medicare Plan Finder tool, you put in the list of prescriptions that you think you may need to use in the following year, and you compare plans on that basis.
There it is.
All right.
All right, Wade. I think that's a wrap.
Sure is.
All right, everyone. Thank you for your time. We really appreciate you inviting us to be part of your day, and we'll catch you next week. What do you think, Wade? That's a nicer and gentler Alex.
Yeah, there you go. Thank you for making us part of your lives.
I didn't know what I was saying. I was just like meandering. All right, everyone. We'll catch you next week on Retire with Style.